Hi everyone, welcome back to Saheb Academy. Now in today's video we're going to understand how to prepare the ledger accounts, also known as T accounts, and we're going to see from the journal entries how we are going to prepare these ledger accounts, and so what's the need of these ledger accounts and how we are going to benefit from that. All these things we are going to discuss in this video. But before moving ahead with this video, please make sure you have watched the previous videos, the accounting basics video where we have discussed the meaning and everything of accounting, that we start this process from source document till the financial statements, how does this work, and then we have also discussed modern rules of debit and credit, the classification, the definition of each and every item, so you should have a proper understanding of all these basic things. Fine. And then one more thing I haven't discussed with you in the previous video, that's the subsidiary books. See here, we start the accounting process from the source document, invoices, bills, vouchers, and all these things, the evidence of transaction, and from that we record, we do the original recording into the journal. That's what I've told you. Yes, that's what will happen. But this journal will not be a single book. Okay, journal will not be a single book. It will be many number of books. Cash book, and then purchases book, sales book, sales return book, purchase return book. So many books will be there. So we'll discuss that later in coming videos. Okay, because first I wanted to make you understand the ledger. Because while explaining the subsidiary books, what I'm going to do is I'm going to teach you how to prepare the subsidiary books as well as how to do the posting of that into the ledgers. So that's why you need to understand the ledger first. Is that okay? Don't worry, we'll clear everything up. Fine. So first let's understand the ledger, and then we'll go back and we'll see how the journal is split into many books and everything in the coming videos. Okay, not in this video. Fine. So in this video we are going to only focus on the ledger. Is that okay? Right. So let's start the video and let's understand how to prepare the ledger accounts and why do we do it. Now first let's understand what do we mean by ledger. See, it's very simple. A ledger is a book in which whole bunch of T accounts are grouped together. Okay, for example, see here you have a book, and in that book you have car account, furniture account, purchases account, machinery account, all these accounts you have in that book. So that book will be called as ledger. Simple as that. And then those T-shaped accounts are called as what? They are called as ledger account. Ledger account is a T-shaped account that is contained in the ledger book. The left hand side of that account, of that T account, always will represent the debit side, and the right hand side will represent the credit side. Is that okay? So now there are three different types of ledger. There are three different types of ledger book. See here, you have general ledger, debtors ledger, and creditors ledger. Okay, in general ledger you will take all the T accounts, mainly all the T accounts. Okay, whether it is purchases, sales, furniture, everything will go into the general ledger. All the ledger accounts will go into the general ledger. But then you also have debtors ledger, which will contain T accounts of credit customers. If you want to know, for example, you have a customer called as Vijay, fine, and he has purchased goods from you on credit, and you want to know how much money does Vijay has to pay to you, then what you will do? That detail will not be there in general ledger, because in general ledger you will have a sales account, and that sales account will be prepared on total basis. You will have, okay, we have made 1 lakh sales till now. From that, how are you going to understand that how much money you have to receive from Vijay? You will not be able to understand that. You will have a total debtor account over here in the general ledger. From that also you will not be able to understand how much money you have to receive from Vijay. What you're going to do is you are going to go to the debtors ledger, which will contain the individual account of Vijay. From that account you will be able to understand what is the balance in that account and how much money you have to receive from Vijay. Is that okay? So that's why we have debtors ledger, and in that we prepare T accounts of each individual credit customers. And then we have creditors ledger, okay, which will contain the T accounts of individual suppliers. For example, let's say you have a supplier Freddy, and you want to know exactly how much money you have to pay to Freddy. Fine. So how are you going to come to know that? Simple. You are going to go to the creditors ledger, individual accounts of Freddy, you will see the balance, and from that balance you'll be able to understand how much money do I have to pay to Freddy. Simple as that. You can't go to the general ledger, because in general ledger you will have a total creditors account, but in that total creditors account there will be a total balance 80,000. How are you going to understand how much money you have to pay to Freddy? No, that data will not be there in general ledger. Okay, that's why we have a separate books, debtors ledger and creditors ledger. Is that okay to you? Fine. So these are books. These are not ledger accounts. Ledger books, general ledger, debtors ledger, and creditors ledger. Is that okay? Fine. So that's regarding the ledger. Enough regarding that. coming to the ledger account, yeah, let's talk about ledger account. So as I said, ledger account is a T-shaped account which is contained in the ledger book. Car account, furniture account, machinery account, so many accounts are there, yeah. As I said, Vijay account, Freddy account, yeah. So those are ledger account, those are ledger account. The left hand side represent the debit side and the right hand side credit side. Now why do we need it? Why do we prepare the ledger account? See, we have already recorded the transaction from the source document in the journal entries and also the subsidiary books. Yeah, as I have told you, we will have sales day book, we'll have purchases book, we'll have purchase return book, sales return book, all these books will have. Yeah, we have made the prime entry. Yeah, we have made the original recording of the transaction in the journal and as well as the subsidiary books. Fine. Now what do we have to do is we have to summarize those transactions relating to each category and to each party by making theirs separate ledger account. Yeah, for every name you take in the journal and in the subsidiary books, for that every name you will have to open a separate ledger account and you have to summarize all that transaction into one. So that's what we're going to do over here. So see here the format and everything. Ledger account format, see here you have this format: date, particulars column, journal folio, which is just a page number of the journal book, and then you have amount. Now why do we call this as T-shaped account? Because it is T-shaped. See here, it's T-shaped. You have the same things over here: date, particular, journal folio, amount, date, particular, journal folio, amount. Journal folio is just the page number, okay, just the page number of the journal book. Is that okay? Because if you have a posting over here, we call a posting, okay, the recording which we have done in the ledger account, it is called as posting. Fine. So if you want to know the details of that posting, the original entry of that, then you will have the page number of journal over here at the side, so you can easily go back to the journal and find that entry. Okay, that's why we have this journal folio column. Is that okay? Right. So this side represents the debit side and this side represents the credit side. The left side is the debit side and the right side is the credit side. Is that okay? Debit and credit. It will always be like that. Okay, it will never change. Okay, for every ledger account it is same, whether it's an asset, whether it's a liability, it doesn't matter. Debit, credit, simple as that. Fine. So now coming back to that question, why do we need the ledger accounts? Yeah, why do we prepare it? See, it's very simple. See here, ledger accounts summarize all the individual transactions that we have recorded in the journal and subsidiary books. Yeah, see, from the source document we have made the original recording in the journal. Fine. Now what we are doing is we are summarizing the journal entries into separate ledger accounts so that we can have one figure of each account and we can take that to the trial balance. Yeah, we can take to the trial balance here and it gives you one figure. After preparing the T ledger account of each account, what will happen is you will get a figure and that figure will be taken to trial balance and then to financial statements. Yeah, that will be happening. Fine. But now you have to understand this practically. See here, let me just give you one example. See, for example, let's say you have a supplier Freddy, okay, and from this Freddy you purchase goods on credit, and in this month, for example, you have purchased 25 transactions are there in total. Yeah, you have received the goods, you have paid some money, like that. 25 transactions are there, so obviously there will be 25 journal entries. Now your manager is coming to you and asking you, see, Mr. Accountant, how much money do we have to pay to that Freddy, our supplier? He's asking this to you. So now what are you going to do? Are you going to go and find the journal entries of Freddy, which will be scattered over in the journal book? Because, Freddy entries are happening on, just for an example, it's happening on 2nd December, 15 December, 14 December, like that. In chronological order, it will be, of course, in the continuous order, but it will be scattered over, right? So first you will have to find the journal entries. And then you will have to analyze, okay, this much we have purchased, this much money we have paid on this date, okay, again we have purchased, again we have paid this much money. So 25 transactions have happened and 25 entries are there. It will take so much time to analyze that, to calculate that and give one figure to your manager, isn't it? After doing all these things, yeah, all this cumbersome work, you will have to tell to the manager, after doing so many works, I have found out the money we owe to the supplier, that is 50,000. Yeah, so it took you so much time. Rather than going into the journal entries and analyzing and all that, what we can do is, as soon as you pass the journal entries or you record in the subsidiary books, directly you will post the posting in the ledger accounts, in the T account of Freddy. Okay, whenever some transaction happens, okay, you will take the source document, record in the journal entry and do the posting in the ledger account. Yeah, if you do that, then what will happen is, whenever your manager will come to you and ask regarding that Freddy or whatever it is, yeah, whoever the person is, whatever the account is, Yeah, then what you will have is in that ledger account, all the entries will be summarized into that one T-shaped account, the debits and credits, and you will have one figure in that ledger. You will have one number, one figure in that ledger, and you will take that number and directly tell it to your manager. Okay, Mr. Manager, we owe 50,000 to our Freddy supplier. Yeah, it will be easy for you. That's why we prepared the ledger account. Yeah, we can't go to the journal and keep on analyzing each and every time we need information. No, we can't do that. We will make use of ledger, because in ledger we'll have one balance. Pick that balance, tell it to your manager or whatever, yeah, wherever the information is needed, right? So that's why we prepared the ledger account, to summarize all the individual transactions listed in the books of prime entry, journal and subsidiary books, so that it gives you one figure, one number of each account, which will be taken into trial balance and then to financial statements. Simple as that. Is that okay? Fine. And then the process of doing this, the process of transferring the debit and credit from journal or from the subsidiary books to the ledger accounts is known as posting. Yeah, when you used to record the entries in the journal, we call that as, you know, passing of journal entries or recording of journal entries. Yeah, the transactions are originally recorded in journal and subsidiary books, but in the ledger it is called posting. The journal entries are posted into the ledger accounts. Is that okay? Fine. So that is what posting is. Okay, and then additional tips here: for every name you take in journal, you have to open a ledger account. For example, if you have purchased goods on credit from, let's say, the same Freddy, so of course Freddy account has to be open, and then of course you also have to recognize what the purchases. Yeah, you have purchased the goods, right? So purchases account will also need to be opened. If you have paid the rent to your landlord, and let's say you haven't paid it, yeah, it has become due, then what will happen? Of course, it's an outstanding expense now. Yeah, so outstanding expense account, yeah, rent outstanding account you will have to open, and you will also have to open the liability account. Yeah, so like that, for every name you take in the journal entries, you will have to open a respective ledger account. Okay, so that all the entries relating to that will be summarized into one account, and it will give you one figure which can be taken into trial balance and then to the financial statements. Okay, like that. Is that clear? Now you have understood some basics about ledger account. Now let's move forward and understand different types of ledger account and the balances, opening balances, closing balances, and all these things. Yeah, let's see different types of ledger account. Now here we have 5 different types of ledger accounts, as you can see over here: asset account, expense account, liability account, capital account, and revenue account. Now you have to be perfectly clear with the nature of these accounts, the balances they have. Asset account, expense account, they have debit balances. To increase them, you're going to debit them. To decrease them, you're going to credit them, isn't it? Yeah, drawings, expense and asset, DEA, they have debit balance. Yeah, the debit, the meaning of debit for these items is positive, and the meaning of credit for these items is negative. Yeah, you have to be perfectly clear with this. And then for this group, LCR, liability, capital and revenue, or you can say liability, equity, revenue, or liability, equity, income, whatever it is. Yeah, these guys have credit balance. To increase them, you are going to credit them, and to decrease, you're going to debit them. The meaning of credit for these guys is positive, and debit for them is negative. Yeah, you have to be perfectly clear with this. Simple things, right? So let's talk first about asset account. Now, asset account can be anything. Yeah, it can be furniture account, it can be machinery account, it can be land and building account. Yeah, so that is asset account. It has debit balance. To do the recording of that, how are you going to do? If any transaction that is affecting your asset account and it is causing your asset to increase, what are you going to do? Let's take an example. Yeah, you understand very well with an example. Everyone does. So for example, let's say you have purchased furniture from Nikhil. You have purchased furniture from Nikhil and you're preparing furniture account. Yeah, furniture account you're preparing, it has debit balance. So you have got the furniture from Nikhil. Yeah, you have purchased on credit. You haven't paid any money to Nikhil. Fine. So furniture account, what are you going to do? You're receiving the furniture, the asset is increasing. So furniture account debit, furniture account debit. Yeah, you will go to the debit side, furniture account debit. How debit? Why your furniture account is increasing? Why? Because you have got it from Nikhil. So on the debit side, you will write to Nikhil account. You will write the amount. For example, let's say 1 lakh. Yeah, like that. You have to do it. Yeah. For example, let's say you have sold the furniture to someone. You have sold the furniture on cash. Okay. You will not take name. You have got the cash directly. So what are you going to do? From this transaction, by selling my furniture, my furniture account will decrease. Yeah, I had 1 lakh worth of furniture. Let's say you have sold it for 80,000. So what you're gonna do? You are gonna take over here, see, furniture has been decreased, your asset has been decreased, furniture account decreased because I have sold it for cash. So furniture account decreased because of cash, so you will take over here by cash. Like that you have to do the posting of ledger accounts. Now you will be wondering, sir, you are teaching us to do the ledger posting directly without the journal entries. Yes, that's what I'm doing. I want you to understand how to do the ledger postings without doing the journal entries. Why is that? Because in professional exams and all, what will happen is they will ask you to prepare the ledger accounts and you will not have enough time to do the journal entries and all. Yeah, and there will be no marks for journal entries, just for the ledger accounts. So what you're gonna do? Are you gonna do the journal entries and then do the ledger accounts? You will not have time. You will not have enough time, right? So that's why I want you to understand how to do the ledger postings without even seeing the journal entries. You just have to visualize the journal entries and do the ledger posting. Is that clear? So that's how we are going to do the ledger postings. But while solving the problem, it will be very clear for you. Right now, I had just shown you an example. Is that okay? Right. So now let's come to these balances. See here, come to the asset account. So asset account has debit balance. Yeah. So the opening balance of this account will be shown on the debit side, and the closing balance of this account will be shown on the credit side. Yeah, asset account means what? Land and building, furniture, car account, computers account, all the assets. Yeah, it can be anything. It's not like asset account. No, it can be anything. Car account, debtors account. Debtors account is also what? It's our asset. Yeah, bills receivable account. Yeah, so all these things are your asset. So they will always cash account, always they will have debit opening balance. The opening balance will be on the debit side and closing balance will be on the credit side. Now you'll be wondering, sir, we don't know anything. We are science students. Yeah, we have come from the humanities stream. We don't know what is this opening balance and closing balance. Please elaborate for us. See, it's very simple. Let's say you are on 1st April. Yeah, the first day of the financial year. Yeah, let's talk about this 2020 only. Yeah, so 1st April 2020. So now whatever asset you had in the previous year, let's say you had plant and machinery of 80,000 in the 2019. So now today is 1st April 2020. So what are you going to do? On the last day what you had, that would be the opening balance on 1st April 2020, and you are going to take that over here to balance brought down, to balance B by D, or you can also say to balance brought forward, B by F. Yeah, or B by D. To balance B by D, you will take over here, let's say 80,000. Yeah, 80,000 was the value of the plant and machinery in the previous year. So at the last day, and you're taking it over here 80,000. Yeah, that's what an opening balance is, and it will always come on the debit side in the asset account. Always, whichever account has debit balance, which has debit kind of balance. Yeah, nature of the account is debit. Then it will always have debit opening balance and the closing balance on the opposite side. Okay, now let's say that plant and machinery you had of 80,000, and then of course a year has been passed, and now right now you are at 31st March 2021. 31st March 2021 at the end of the financial year, last day. So now the value has been decreased. Yeah, because of depreciation. You will understand what is depreciation later. Depreciation is the fall in the value of the asset. Okay, so due to depreciation, the value of the machinery is right now not 80,000. Let's say it is 60,000. So at last what you're going to do, you're going to take over here 60,000 by balance carried down, or you can say by balance carried forward to the next year. That's what a closing balance is. So do you understand? Do you have an idea now what is opening balance and what is closing balance? Simple. Yeah, so that's what will happen. And of course you will have the total columns over here like this. Yeah, like this you will have total. Yeah, we'll see that within few minutes how to do the balancing of ledger accounts. Okay, so like this you will have, and the depreciation which I said to you, right, depreciation, that 20,000, it will come over here, depreciation. Why is that? Because the value of your plant and machinery has been decreased because you have used the asset, it has been worn down. Yeah, so because of that the value of the plant and machinery is not same 80,000, it has been decreased to 60,000. So that 20,000 decrease you are going to take it on this side. Why? What's the logic behind that? You haven't told us the journal entry also. I will not tell you the journal entry. Yeah, so it's very simple. Plant and machinery value has been decreased. Plant and machinery account credit. Plant and machinery account credit because of depreciation. You will take over here by depreciation account 20,000. Like that you have to do. Simple. Did you understand? Yeah, so that's what. So this is how you will be doing the ledger postings and everything. Okay, don't worry, I'm just showing you examples over here. We'll do the whole problem and you will feel this is a piece of cake really. Yeah, so that's regarding asset account. Then the same thing, expense account also, it has debit balance. The nature of this account is debit balance. Yeah, so it will have debit opening balance and the closing balance will be on the credit side. And again, in the exam and everywhere, you will not take this plus minus. No, you have to understand expense account has debit balance. So to increase this account, I'm going to debit that. To decrease this account, I'm going to credit that. Yeah. So whenever any expense has been incurred, let's say you have paid the rent in cash, So what will happen? You will open a rent account. Yeah, rent account, ledger account. Rent account will come over here, rent account name. It has debit balance. So rent account, yeah, rent you have paid. So expense has been incurred. So you have to record the expense. So expense is increasing. Expense never decreases. Always remember that. Okay, expense never decreases. Due to some errors, what can happen? You might have to reverse the expense entry. That's different. But here you have paid the expense. So expense has been incurred. You have to record the expense. So rent account debit because rent account is increasing. You have incurred the expense. So rent account debit, go to the debit side. How it has been increased? How did you incur this expense? You have paid the cash. So to cash account, you will take the value over here. Like that, you have to do the posting of expense and all. Yeah, it's same. Everywhere you have to do the same way. Yeah, if it is decreasing, go to that side. Yeah, like that. Okay, and the opening balance over here and the closing balance over here. Is that clear? Like that you have to do. Fine. So this is regarding the expense account. And then liability, it is exactly opposite of asset and this expense also. Why? Because asset and expense, they had debit balance. Here liability has credit balance. So what you're going to do, the opening balance will come on the credit side. Buy balance brought forward or brought down. Yeah, whatever you want, you can write. And you will take the amount, the opening balance, whatever that was there in the closing balance of the last year. I have told you. Yeah, whatever that was there in the 2019, it will come over here in 2020. Yeah, that's what. First day. Fine. So that's what you're going to take. And then here the closing balance will come on the opposite side. To balance carried down. Okay. There is not a single exception. Okay. It will always be like this. If the account has credit balance, opening balance on the credit side, closing balance on the debit side. If the account has debit balance, opening balance on the debit side and the closing balance on the credit side. And always asset account, expense account will have debit balance, and always liability accounts such as creditors and many bills payable, all these guys will have credit balance only. And the same way you have to take the opening balance and closing balance. Is that clear? Fine. Now capital account also same thing, same like liability. Opening balance over here, closing balance over here, all the rules and everything is same only. Yeah, because this is one group, LCR. Yeah, so revenue or income account the same way, opening balance over here, closing balance over here. Yeah, for example, let's say one posting about the liability. Let's say you are doing creditors account. Yeah, let's say you are doing creditors account, and let's say you are preparing Freddy account. Yeah, we have been talking about Freddy. So Freddy account, Freddy is your creditor. Fine. So let's say Freddy is your creditor, so you have to pay money to Freddy, isn't it? That's your liability. Yeah, simple as that. So let's say you have purchased goods from Freddy for of 30,000. So what's the posting you are going to do over here? Simple. You have purchased the goods from Freddy. So now what is happening? Freddy account is a liability account. Is it increasing or decreasing? You have to pay more money to Freddy. So liability is increasing because you have got the goods from him. Nah, if you have got the goods from him, then you have to pay more. Nah, right? So you have to pay more. So your liability is increasing. Creditors account is increasing. Freddy account is increasing. So go to the credit side. Yeah, it is increasing. Go to the credit side. How did it increase? You have made purchases from him. So you will take buy purchases over here. Freddy account has been credited because of purchases, buy purchases, 30,000, whatever the amount is, you are going to take it over here. Is that clear? So that's how you are going to be doing the postings. It's very simple. Just see how the transaction affects your account. Does it increase or decrease? Yeah. Now here increase is what? Debit. Decrease is credit. But here increase is credit. Decrease is debit because this has credit balance, credit balance, credit balance. Yeah. Is that clear to you? So these are the different types of ledger account. And if you are wondering about that drawings account, then drawings is exactly opposite to capital. Yeah. The methodology will be like, asset and expense. Like that you will have to prepare the drawings account if it is asked. Yeah. So that's what you have to do. Okay. In drawings account, what will happen? The opening balance on the debit side, the closing balance on the credit side, like that. Is that okay? So this is how you will be preparing the ledger account. It's not a big deal at all. So till now you have understood how to do half posting of a transaction. but here we are doing double entry. We can't just do half posting. We have to understand the complete posting, double entry effect. Yeah, so let's take that Freddy example. When we did that Freddy example, what did we do? We said that we have purchased the goods from Freddy and our liability has been increased. We have to pay to Freddy. So Freddy account will be increasing, liability is increasing, go to the credit side. Buy purchases, yeah, it increased because we have made the purchases from him on credit and we took over here 30,000. Yeah, that's what we said. But that's just half of the transaction. We have to show the dual effect, the other effect in the purchases account. Now what is purchases account? Purchases is an expense account. So go to the purchase account, expense account. Yeah, it has debit balance. So our purchase, is it increasing or decreasing because of this Freddy transaction? It is increasing. Yeah, because we have got the goods. Yeah, we have purchased. So purchases is increasing. So come to the debit side and then how it increased? It increased because we have got the goods from Freddy. So to Freddy account, you will take the same amount, 30,000. Yeah, that's the idea. That's how you have to do the complete posting of a single transaction. Every transaction will have dual effects. Yeah, at least two accounts will be affected and the amount will be same, 30,000, 30,000. Yeah, same like, you know, in the journal entry. Yeah, a debit and a credit like that. Is that okay? Right. So that's what you have to do. Let's take another example to understand this even further. So we said that first that we have purchased furniture from Nikhil. Yeah, on credit. We haven't paid any money. So the first posting was, half posting was, what did I explain to you was that we have purchased the furniture. So we have got the furniture. Furniture account is increasing. Go to the debit side to Nikhil because we have got the furniture from Nikhil on credit. Fine. But now you have to show the other effect in the Nikhil's account. See, it's very simple. Go to the Nikhil account. Nikhil is your liability. Yeah, you haven't paid any money to him. You have to pay, right? So Nikhil is your liability, your creditor. How the recording will happen? Simple. No, not the recording, the posting I mean. So Nikhil liability, our liability to Nikhil is increasing. So go to the credit side and right over here buy furniture because liability is increasing because we have got the furniture from him on credit. Yeah, that's what you have to do. Simple as that. Shall we take another example? Yeah, let's take another example. Yeah, let's say we have paid money to Freddy. We have paid money to Freddy. So Freddy is our creditor. Yeah, so let's say we have paid him 10,000 rupees. Fine. So liability to Freddy will decrease because we are paying money to him. So Freddy account will decrease. So here you will take Freddy account credit. Freddy account is getting credited because we have paid cash. So to cash 10,000 like that. But the other effect would be you have to go to the cash account and cash is your asset account. Go to the cash account. There what will happen? Your cash is decreasing. Yeah. So cash account credit because cash is decreasing. You are paying the money, right? So cash account credit. How? Because you have paid it to Freddy. So here you will take buy Freddy account 10,000. So this is how you are showing dual effects of a transaction. Is that clear to you? It's very simple. It's very easy. Yeah. Just first do the half of the effect and then do the opposite posting in the another account. Yeah. Here you did what? Freddy account debit. Yeah. Because the liability to Freddy is decreasing because we have paid money to him to cash. And then in the cash account, in the asset account, our money is decreasing because we have paid to Freddy. Like that. Buy Freddy account 10,000. Simple as that. Yeah. It's not a big deal. Yeah. So that's what I did. I went slowly. First, I explained you the half of the effect and then I completed the effect by showing you everything. Now I talked about the depreciation. Now in depreciation, what would happen? As I said that we had plant and machinery, 20,000 depreciation. So plant and machinery value decreased, yeah, because of depreciation. So by depreciation 20,000, then what you will do? You will go to the depreciation account. Now depreciation is what type of account? Depreciation is an expense account. All right. So we will go to depreciation account. So what has happened to depreciation? Is it increasing or decreasing? Depreciation is increasing. I've always told you expense never decreases, it always increases. There was no depreciation previously. Yeah, depreciation happened in this year, as I said, in 2020, right? So depreciation is increasing because our plant and machinery. Yeah, 20,000 like that you have to take. Yeah, see, plant and machinery decrease because of depreciation. Depreciation is increasing because of plant and machinery to plant and machinery. You will take the amount. Like that. Okay, both the effect you have to do simultaneously in two accounts like that, or three accounts sometimes, but three accounts will not come to you because you are in the basic level. Yeah, so yeah, I just wanted to explain to you, right? Fine. So this is how you have to do it. Now what we're going to do is we are going to see the balancing of accounts, how we're going to balance. Yeah, let's just do some rough calculations and I will show you with rough calculation how to do the balancings. Yeah, and then we'll move on to a problem in the next video. Yeah, so let's just see how the balancing happens. Fine. I'm sure you're clear with this dual effects and everything. Yeah. Now let's see how to balance the ledger account. See, it's very simple. Let's say we have cash account. Okay. So let's say there was opening balance of 1000. We had 1000, and then somehow we got the receipts. Since you know, right, plus and minus, cash account is plus and minus. Yeah, it's debit and credit. Yeah, it's an asset account. So we had opening balance of 1000, and then we got money from somewhere 500, then we got another 600 from somewhere, and then let's say we have spent 400, okay, and then 600, okay, that's all. Then the year ended. Just for an example, don't take these figures or anything seriously. Yeah. So now how we are going to balance? First you will take these two, total figures, total columns, I mean. Yeah. So 1000 plus 500 plus 600, how much is that? That's equal to 2100. Yeah, 2100. So which side is bigger? Of course this side is bigger, and there is a deficiency, a shortfall on this side. Yeah, so what you're going to be doing is blindly you are going to put the bigger figure on both the sides. Here it's equal to 2100. Yeah, so 2100, 2100. And what's the shortfall over here? The shortfall is 1100. So what you're going to do, you're going to take 1100 on the credit side. Simple. Directly you're going to take, and you will write over here by balance carried down or carried forward, by balance C by D. That's how you're going to balance the ledger account. Simple as that. Okay, so let's say the creditors account. Now let's say 1000 opening balance was there, just for an example, 600, and then here let's say 400 you have paid to the creditors, and the liability has been reduced. Yeah, because it's like this, right? Plus minus, minus plus, sorry. Yeah, so now how are you going to balance this account? The same way which you did in the cash account. Yeah, take the total columns. Which side is bigger? Debit side is bigger. 1000 plus 600, that's equal to 1600. Yeah, so again the same thing on both the side. You have to write it blindly. Yeah, 1600, 1600. The shortfall over here is 1200. Yeah, 1600 minus 400, that's the shortfall. This is the shortfall. Yeah, so you will write over here to balance. What? To balance carried down. Yeah, here it was by, here it is to, isn't it? Because this is on the credit side, this is on the debit side. Yeah, I have already explained to you, isn't it, that the creditor, they will always have, I mean the liability account, they will always have closing balance on the which side? On the debit side. And for the asset account, always on the credit side, like that. So these are the closing balances. Fine. And then let's go to the rent account. Now in the rent account, let's say that what do you say, the rent account, you have paid the rent, right? So let's say you have paid the rent of 20,000, just for an example. So nothing on the credit side. Okay, so simple, there is nothing there, that's it. So 20,000 on both the sides, 20,000 on both the sides, nothing, right? 20,000 shortfall, so take 20,000. This is our closing balance. So I will write over here what? By balance carried down, C by D. Simple. This is how you will be balancing the ledger account. Simple as that. Now when we'll go to the problem in the next video, then you will feel like balancing is not a big deal. You will just focus on the process of posting, that's all. Yeah, because balancing will not be a big deal for you. It's very easy. Wherever there's a shortfall, I will write to balance or by balance, wherever it is, and then carry down only. Yeah, that's simple. And I understood, just a shortfall. I'm science students, I'm very good with numbers. Yeah, I know the math subject and everything, you will say. Fine. Yeah, so this is how you have to do it. Balancing is very simple. It's not a big deal. Yeah. Okay, then see you in the next video. Yeah, we'll do one problem there of the ledger account posting, so you will be perfectly and practically clear there. Okay, then see you in the next video. Bye.